Hello traders, you're welcome to this video. So in this video, we are going to be looking at some of the best divergence indicators. Indicators that you can use to spot trend reversals, okay? Now, basically, we are going to be looking at the RSI, which is the Relative Strength Index, the MACD, which is the Moving Average Convergence Divergence, and the Stochastic Oscillator. So these are three of the best divergence indicators you can use to spot both regular and hidden divergence. Okay, so we're going to be starting with the RSI. Let's just load on the RSI to our chart. Okay, so the RSI is a momentum oscillator. It measures the speed and change of price movements. It ranges from 0 to 100. As you can see, it's commonly used to identify overbought and oversold conditions, but it's also excellent for spotting divergences. Now, in terms of regular divergence, it occurs when the price is making a higher high, but the RSI is making a lower low. So let's just look for an example. When price is making a higher high, but the RSI is making a lower low. Okay, you can see this is an example here. Price is making a higher high, RSI is making a lower low. Okay, so this signals potential weakness in the trend, suggesting a possible reversal. Now, this is a bearish divergence, so it suggests a possible bearish move. Okay, so although this seems to be a bullish structure, but this divergence signals that this bullish move is coming to an end. Now, as for hidden divergence, this is just a regular divergence. Hidden divergence happens when price makes a higher low. Okay, price makes a higher low while RSI makes a lower low. Price makes a higher low while the RSI makes a lower low. This indicates that the underlying trend is strong, even if it looks weak. So let us look for an example where price is making a higher low, but the RSI makes a lower low. Let us look for such an example. Okay, I think we have an example here. Okay, price makes a higher low, but the RSI makes a lower low, as we can see here. So now this shows that even though this looks as if it's looking as if this is a bullish hidden divergence, right? Because it shows that the bullish trend is still strong, although it looks as if it is getting weak because of this lower low made by the RSI. But this hidden divergence shows that the bullish move is likely to continue, and we can see that the bullish move actually continued all the way up to this place. Okay, now that is how the RSI works. That's how the divergence works on the RSI. Now let us look at the MACD. Let us look at the moving average. Okay, let's add on the MACD to our chart. So now the MACD is used to follow trends and momentum, and it's great for detecting both regular and hidden divergences. Okay, so for a regular divergence, it is, in this case, it is still the same technique when price is making higher highs and the indicator is making lower highs. Okay, so it's suggesting a weakening trend and potential reversal. So let's just look at these options that we use here. You can see that the indicator gave the same divergence around the same spot. So that's the reason why, irrespective of the indicator you are using, make sure that you are using a good indicator for spotting divergence. You can use either RSI or MACD or Stochastic Oscillator. You don't have to use the three of them at the same time, because you can see that the same level that I used to identify divergence on RSI, the same level the MACD is also showing us a divergence. So you could have used the RSI, you could have used the MACD. Most likely Stochastic is also going to show us divergence at the same level. Okay, so basically it remains the same. The price is making higher highs, the indicator is making lower highs, showing that the bullish move is probably coming to an end. And then for the hidden divergence, the price is making if the price is making let us use a sell this time around. Let's use a sell this time around. When the price is making lower highs, but the MACD is making higher highs. Okay, let's look for such example. The price is making um, lower highs, but the MACD is making higher highs. Okay, this is just like a very, an example, although it was not, the waves were not very, wide apart. But we can see that there was higher highs here, there was lower highs here. So this shows that the current trend is actually stronger than it appears. Okay, so even though even though we have price even though we have the momentum looking as if it is getting weak because of these lower highs, it looks as if the momentum is getting weak, but the trend is actually stronger than it appears. And we can see that although there was a retracement, the price eventually continued to this point before a sell now finally happened here. So when you are using the MACD, when you are using the MACD, remember that the MACD has a zero line. It has a zero line. So when you are looking for divergence, for example, when you're trying to spot lower highs with the MACD, remember that the lower highs should be above the zero line. Yeah, so you will not be looking for highs below the zero line, obviously. So the lower highs or the higher highs should be above the zero line. But when you are looking for lows, then lows would be below the zero line. Okay, highs are above the zero line, lows are below the zero line. Okay, so now we're just going to we're going to look at the stochastic oscillators next. We're going to look at the stochastic oscillators. Look at the stochastic oscillators. Okay, all right. Now, there's the stochastic oscillator. It compares a particular closing price to a range of its prices over a specific period. Now, this indicator is particularly good at identifying overbought and oversold conditions along with spotting divergences. Now, for a regular divergence, price makes a higher high, but the stochastic makes a lower high, indicating a potential reversal. Okay, so we can see price was making higher high here, whereas the indicator was making lower high. So that showed the potential reversal. You can see that eventually the price reversed. So when you see this, it indicates a bearish divergence, right? You can see that price eventually reversed. That's for a regular divergence. Now for a hidden divergence, this is when price makes a lower low, for example, but the stochastic makes a higher low. Okay, let us look for an example. Price makes a lower low, but the stochastics makes a higher low. Okay, we can see that here we had price making lower lows, but here we can see that there was a higher low form, just a bit though, just a little bit. Okay, just a little bit. So we can see that the even up to this point, you can see the higher lows continued up to this point, but this was forming lower lows, and eventually the sell trend continued all the way down to this place. Can you see it continued all the way down? So when you spot it, when you notice this hidden divergence, it's called a hidden divergence. The price is making lower lows, the oscillator is making higher lows. So it shows that the downtrend may continue. The bearish hidden divergence shows that the downtrend may continue. Okay, so now some key steps for spotting divergences. Of course, you have to add the indicator of your choice, whether the RSI or the MACD or the stochastic oscillator. You add it to your chart. Then identify regular divergence to signal potential trend reversal. Regular divergence signals potential trend reversal. Regular is when price is making higher high, but the oscillator or the indicator is making lower high, or price is making lower low, but the indicator is making higher low. Okay. Yes. Then okay, sorry. So I was saying that remember that you will choose the indicator of your choice, and then you identify your regular divergence, regular divergence, which is when the price is making higher highs, but the stochastic is making lower highs. For example, now in that case, that is a bearish regular divergence, a bearish regular divergence. Then, on the other hand, for the hidden divergence is when, for example, you have price making a lower low. You have price making a lower low, for example, and then the stochastic is making a higher low. For example, yeah, you can use that to spot hidden divergence. So when you combine divergence analysis with other technical signals for stronger confirmation, it is very useful. When you combine the divergence analysis with other technical signs, chart patterns, candlestick patterns, for stronger confirmation. By mastering these divergence indicators, you'll be able to improve your market analysis and make more informed trading decisions. So I hope you found this video insightful. Kindly like and subscribe for more trading insights. Cheers and happy trading.